Mario Draghi once again he pushed the aggressive measures by cutting the rate by 0.25% as expected. But do you think that it's the magic pill to heal all the problems that Europe has been facing?
I think that's a really good question. I think it's a shame we haven't got Mario Draghi here to ask him that question. Actually, I was reminded when I was a student many years ago. Right. I had this poster on my wall, and it said something like, someone said to me, "Smile, things could get worse." So I smiled, and then they got worse. And that's a little bit to me like where we are with Europe right now, because I remember just over a month ago, Mario Draghi was saying, there's not going to be any rate cuts. We don't need rate cuts unless things get a lot worse. And here we are, and everybody seems to have forgotten that he made that speech. And
so
just over a month later,
now.
It must be a lot worse now. And yet, when you listen to the language and the rhetoric that Mario Draghi uses, it's all incredibly positive. So I just have this problem understanding how a month ago we didn't need rate cuts unless things got much worse. And then last night we have this situation where, crikey, all of a sudden we do need a rate cut, and yet he's still trying to use positive language. And I think I think there's a real issue in Europe, more so than anywhere else in the world, that we had the speech from Draghi last year where he said he'd do whatever it takes, and the euro was irreversible. And he spent a long time talking about bumblebees, and I don't really know what he was trying to tell us, but somehow it distracted everybody. And he promised a lot of action. They came up with this new acronym, OMTs, outright monetary transactions, and yet they haven't actually done anything so far. So there was a lot of fantastic language last year out of Draghi, and yet there was no action at all. And I worry that, again, yesterday we get some upbeat sounding messages coming out of Draghi, but all we get is a 25 basis point interest rate cut. And, it makes absolutely no difference. It makes no noticeable difference at all to places like Greece or Spain or Portugal or Italy, whether we have 75 basis points, 50 basis points, 25 basis points. When the interest rates are so close to zero, then actually making one more interest rate cut, I don't think makes any real difference. So I think where we're at now, and probably Nouriel Roubini, who I've mentioned a lot of times before, probably expressed this better than anybody. Last year when we got the speech from Draghi, he said, well, you know what, this is papering over all the cracks. It's going to make everybody feel good. Sentiment is going to get better. We saw the bond yields come back down to manageable levels. All of that happened, but just because the head of the ECB stood up and said some positive things, which don't seem to be, they don't seem to be backed up by reality, and they certainly haven't been backed up by any action. The ECB has taken the least action of any of the central banks so far. Now, it was Japan. Japan was the central bank that was lagging behind, but we've all seen what's happened there. They're making up for lost time and going absolutely crazy. Exactly, they're really going to town. So, and in the States, we saw some response in 2009, some response in 2010, and I think a lot of people are forgetting that the measures that we have now, the $85 billion a month in the States, are they're huge. That's $1 trillion a year. So that's if we keep that going for a few years, that outweighs everything that's been done so far. So the Eurozone is kind of conspicuous by the fact it's not really taking any action. It's promising all sorts of things, but it's not actually doing anything. And I think a 25 basis point cut, it's not going to make any difference at all to the underlying problems that are affecting, the periphery or the gypsy economies, as we call them, the Greece, Ireland, Portugal, Spain, Italy. It's not going to make any difference there. We've got 30% unemployment rates in some of these countries almost. So, nothing about a 25 basis point cut is suddenly going to get people back to work.
Stimulate the growth of the lending to the corporate companies or something?
I don't think so, because I don't think interest rates is the problem. I think the fact that corporates who are in a fairly good, fairly solid financial position don't want to borrow money at the moment because they don't want to invest, they don't want to hire. Their big problem is that they really don't have anybody to go and sell to. They don't have anybody to sell products or services to, because of the fact we've got high unemployment and we've got falling wages, and we've got a really bad consumer outlook in Europe. So companies don't want to invest, so the good companies don't want to borrow. The companies that need money, that desperately need money, are so bad they can't actually go and borrow money. So I don't think this is going to help that situation. It's not going to. It's not going to stop companies that are in trouble getting deeper in trouble, and it's not really going to encourage companies that are in a good situation to go out and start investing. And you know, it shouldn't do. If I was a CEO of a European company right now, I'd be doing everything I can to cut costs. But unfortunately, while that might be good for your company, it's bad for the bigger picture, because again, it just acts as even more of a brake on spending. So unless we do something structural about the fact that, you know, these peripheral economies have way too much debt, they're not able to go and compete with the core economies, they're not able to compete with Germany or Holland or, you know, any of the core efficient economies. Because of that, I don't think anything's changed in Europe, and I think, you know, the only thing that we're seeing we had an interest rate hike in Ireland. The banks in Ireland, even though their borrowing costs are now lower because of Draghi's rate cuts, actually went and increased what they charge customers for mortgage loans. They went and virtually doubled the interest rate on mortgage loans. So, you know, whatever he's doing, it's not filtering through to the real economy. And, you know, it's not going to filter through to the real economy unless we do something really structural about, you know, stopping the transfers from the periphery that can't afford it into the core that can. And, you know, we're seeing Germans slow down. I think, you know, one place where maybe there might be some support for what Draghi's done is in the core, particularly in Germany. Germany's been slowing down. Maybe something like 25 basis points rate cut can give somewhere like Germany a little bit of a stimulus, a little bit of a shot in the arm. But even so, it's fairly short lasting, and it's not really going to do anything to address Germany's problem, which is that, you know, Germany is part of a trade bloc where it's sharing a currency with countries that can't compete on those same level currency terms.
Right. But do you think that is some kind, like, you know, the buy timing for you know, the debt problems countries?
No, absolutely. I think, you know, everything that Draghi's done by making these speeches, by, you know, being positive, then, you know, it's almost like he puts off having to deal with reality. I was telling some of my clients the other day that back 20 years ago when we had the Gulf War, then Saddam Hussein had a spokesman who became known as Baghdad Bob. That was his nickname. And this guy would come out and give like an update on the war, and he'd say, oh, you know, we're winning, everything's great, everything's fine. But actually you could see there were bombs flying over his head and bullets whistling by him, and, you know, the whole country was about to collapse. It was about to get taken over by the Allied armies, and yet, you know, he was still standing there saying, no, everything's fine, there's no problems here. And we sort of have that feeling a little bit about Draghi, that he's saying, no, everything's great. And because of that, as I say, he's not dealing with it. And I don't think that buying time is helping, because if you look at it, the trajectory is getting worse in these peripheral countries. Things aren't getting, there's no point buying time if over time things actually deteriorate. The only point to buy time is if things are going to improve. So, you know, maybe you get over a liquidity hurdle, or you get over a solvency hurdle because you're making profits or you're doing something constructive. But if actually you buy time and things get worse, then, you know, it's a little bit like, you know, like I said at the start, you know, people said smile, you know, things could be worse, so I smiled and they got worse. And I think that's where we're at. I think things are just getting worse and worse all the time. Right. And I think, you know, what happens next? We get another 25 basis points cut and another 25 basis points cut. You know, we could literally be at negative interest rates, and none of that is going to help the periphery. And unless we sort out places like Italy and Spain, then Europe's not going to function as an economy, and that's starting to infect places like Germany right now.
Right. Do they need some kind of, like, you know, other combination of the stimulus package, rather than, you know, by the cutting rate? Which one would you recommend?
I think what they can do is default. I think we have to have defaults from the periphery. I think we have to have the breakup of the euro. I don't think anything can be fixed while ever we still have this single currency in place. If they were to go and let some of the peripheral countries default now.
But that's going to break the Mario Draghi's promise.
Absolutely, but it was a crazy promise. I mean, you know, that's one problem now. Because he's promised this, he's got to keep coming out and, you know, sticking to the thing he said. And it's a bit like, you know, like I said, Baghdad Bob in the Gulf War, he used to say, yes, we're winning. He couldn't suddenly turn around and say, actually, no, we've been invaded and we're all about to be captured, because all along he'd been making out that everything was fine, everything was rosy. So I think that's really Draghi's problem right now, that, you know, he's committed himself to something that's just not possible. And, you know, what it probably does is it probably keeps the plate spinning in Europe. It keeps everything going for a little bit longer. It kicks the can down the road again. You know, that's what it does. But as I said, there's no point buying time if you're not going to do anything useful with it. And you know, we've got to this situation now where it's a lot more critical in Europe, I think, than people realize. The fact that we have now this non-fungible currency, the fact that, you know, if you have euros in Cyprus, they're not worth the same as euros anywhere else, because you can't take them out of the country, you can't take them out of the bank, you can't transfer them. So, you know, that limits the value of these euros. So Cypriot euros are already second-class euros. I think that the strategy, if the ECB's got one, is that it's trying to make all of the peripheral euros into second-class euros and treat the core euros as being kind of first-class euros. So we'll still have a single currency, but it'll be worth more in one place than it will in another. But you know, I can't see how they're ever going to be able to do that in practice. And it seems to be what they're trying to do. That seems to be why they're trying to buy time.
What about in terms of the impact to the other capital market and also the other central banks' action? Do you think it's going to affect the Bank of Thailand's rating cuts, or some kind of the impact all over the world?
I hope not. I mean, I think maybe it creates a little bit of pressure for other people to start cutting rates, or the other argument is that actually maybe it takes a little bit of pressure off, because we've seen already that capital markets in the short term, Asian capital markets, most of them seem to have responded favorably. We've had some pretty grim news coming out this week with the China PMI numbers, with the American initial labor data, jobless data, exactly. So with all of that stuff, the situation is kind of looking like it's worse, and yet we've still got this mentality out there in a lot of the capital markets, certainly in the equity markets, that it doesn't matter because then somebody's going to take some action. So we get a 25 basis point cut in Europe. And sometimes it takes a little while before we catch up and we realize, actually, that didn't do anything. If we get another month or two of worsening Greek data, worsening Spanish data, that's when people sort of start to question, maybe this isn't working after all. So I can't see that it's going to make a massive difference to central bank policy anywhere, to be honest with you. I think the States is committed to $1 trillion a year. The Bank of Japan are committed to incredibly aggressive stimulus, even though they've admitted that maybe it's not working and they're not going to hit their 2% inflation target. I think in Thailand the best thing we could do is just ignore that, and there's this agreement, I think, between the Ministry of Finance and the BOT that they were going to go away and study what the effect would be on interest rate cuts in Thailand, and then decide policy based on that. Well, I hope that's what they focus on. I think we should look at what the impact is for Thailand. We shouldn't really worry about what Mario Draghi is doing or not doing.
Do you expect to see the capital outflow from Europe, because the cost of funding would be lower? And then it probably would go around the world, the capital.
Possibly, but I think that's marginal. I don't think that's a big effect. I think what we're seeing more in terms of capital is the fact that the States is producing $1 trillion extra cash a year. The fact that Japan is now all of a sudden it's gone crazy in terms of printing and stimulus. So I think they're the capital outflows that we're likely to get. And I think that's a really good point, Ek. You've picked up on what's really the flaw in the system here. Draghi goes out and says, "Hey, look, everybody, I cut rates by 25 basis points," but at the same time, he's not actually producing any more money. He's not, he's not following through on the OMTs. He's not. I don't think he should. I don't think they're a good policy. But I mean, he's not actually doing it. So there's not really a lot of extra capital being created in Europe right now. Capital is still pretty sticky in Europe. It's not flowing. It's not circulating. So I don't think there's a massive impact. I think today you might see, as I say, all the markets rallying because people read the headlines. But I think in terms of real structural impact, I think what Japan is doing and what the Fed are doing in the States, that they're creating money. That's got to go somewhere. A lot of that is still coming into Thailand.